So we're going to start here shortly. Good afternoon, ladies and gentlemen. This is Sierra Pacific Financial Advisors. Today is our very first webinar on alternative investments. My name is Aaron Sanchez. I'm the Client Engagement Manager and also a 401k plan advisor. So the next few months is going to be extremely busy for me. I'd like to introduce you to today's speaker. His name is Daniel Goodman. Daniel graduated from San Jose State University with honors with a degree in economics and business finance. He also holds an MBA from Santa Clara University with a concentration in behavioral finance and quantitative decision methods. Daniel is both a certified financial planner and a chartered life underwriter. He is the director of financial planning here at Sierra Pacific Financial Advisors. He has over 20 years of experience in the financial planning industry and enjoys using his extensive financial planning and investment knowledge to help clients engage and execute their financial dreams. Daniel, his wife, and 3 daughters live in Livermore. They enjoy gardening and raising chickens, and Daniel is also an avid home brewer. Daniel, take it away.
Thank you very much, Aaron. I appreciate that introduction. So everyone, I want to thank you for taking some time out of your day to visit with us today. So what we're going to be talking about are alternative investments and how they can fit and enhance your portfolio. So our agenda for today is we're going to start by talking about what are alternative investments, how they can improve diversification within a portfolio, what are the 4 main types of alternative investments, and then how you can actually incorporate those into your own portfolio. So what are alternative investments? So these are a varied class of assets that do not fall into one of the conventional asset classes, stocks, bonds, or cash. And they can include anything from art and collectibles, from your favorite Monet to your baseball card collection you started when you were a kid. So as we're going to see, alternative investments don't move as these other assets do, as these conventional assets do. They tend to have smaller movements relative to these other assets, and in some cases may actually move in the opposite direction. So the first thing we want to talk about is the idea of correlation. So when we talk about correlation in financial terms, what is that exactly? And it's the degree to which 2 assets move together in either a positive or negative manner. And it's measured on a scale of +1 to -1. And so correlations less than 1, that mean 2 assets will move together, but the asset with the low correlation is less risky. So for example, in the chart, if global stocks drop, then private credit drops something less. Negative correlation means these 2 assets move opposite one another. An example, if the return on US bonds is down, then the return on private credit goes up. And so the idea here is that with this low correlation to traditional assets means when the stock market is under pressure, commodities, for example, could very well be performing quite well. And low correlation reduces overall portfolio risk and helps decrease portfolio volatility. And I'm sorry, I just remembered one piece of housekeeping. The chat function in today's webinar is disabled, but there is a raise hand and a Q&A button that you'll be able to use to ask any questions as we go through today's presentation. So with this idea of correlation, it helps to diversify your traditional portfolio, whether it's say 60% equities, 40% bonds, 70-30, 20-80, or whatever. So these alternative investments help to diversify a portfolio and lead to better risk-adjusted returns. So if we look at the chart, you can see that an investor in the hypothetical diversified portfolio, which includes 20% of these alternatives, it would have had the second best performance in 9 out of 10 years. So an alternative allocation can be an effective strategy against uncertainty and underperformance in individual asset classes. Because as you look at the chart, you can see that just because a particular asset class was the best of class in one year doesn't necessarily mean it's going to be the best asset class in the following year. And so since these alternative investments are less exposed to the broad market, the impact of market volatility can be lower, in some cases significantly so. So then this well-diversified portfolio has lower volatility and lower risk. Any questions about anything so far?
Yes, Daniel, actually, we do have a question. Since looking at the chart, why not be in all equities since it had the best return 8 out of the last 10 years?
Great, yeah, okay. So that's very true. But like, as I said, it's hard to know if last year's winner is going to be this year's winner. So if you look back at 2000 and 2011, equities were the worst performers. And 3 out of the last 10 years, equities were the worst performers out of being the best. So again, just because you were number one year doesn't mean you're going to be number 2 the following year. And also, if you look over the 30-year history, you'll see 25% of the times equities were the worst performing class, while the diversified portfolio was either number 2 or number 3 in terms of return in that same period. It's a great question, though. So one of the things that's very relevant today in this rate of higher inflation is how these assets can be used as an inflation hedge. So the first idea is, is hard assets. And these are those tangible assets that you can touch, you can feel, you can hold. And these types of assets tend to have relatively stable prices. So we're talking gold, oil, real estate, both residential and commercial, and as we said earlier, art and collectibles. And because these have a high positive correlation with inflation, so as inflation goes up, the value of these assets also go up, it makes for an excellent hedge against inflation. And because these assets, in some cases, tend to be illiquid, their prices tend to remain relatively stable over time, compared to stocks and bonds that can move up and down, very volatile on a day-to-day basis or even in an intraday basis. The other category we have here is real estate. And real estate tends to do well during inflationary periods as rents tend to rise. And the other thing too is there'll always be a demand for homes regardless of the economic climate. So as inflation rises, so do property values, and therefore the amount that landlords can charge for rents. So lease renewals, as leases come up, these landlords are able to mark to market these new lease rates. So there's always an increasing rate for rents. And we always want to look for those properties that are fully rented or fully leased out with a lease agreement. So you get a nice, significant continuous income stream. Commodities, which is what everyone knows, especially when we talk about gold and rising inflation, rising interest rates, they're not subject to sensitivity to public equity markets. So the value of a commodity tends to rise and fall with supply and demand. So it's not coupled with inflation at all. And so as the demand for these goods and services increases, prices rise, as does the price of the commodity that used to produce those goods and services. So again, in a rising inflationary environment, having these commodities in your portfolio can definitely help weather the erosion that inflation gives you on some of your less, like your cash assets. So we've talked a lot about what alternatives are and how they work. So one of the things we want to definitely mention is that do come with risk. So one of the main risks we have with alternative investments is they often have higher fees. And these come in the realm of performance fees and incentive fees. So essentially, as the fund does continually better and better, then the fees for the fund manager tend to go up as well. Also, these tend to be concentrated portfolios. And this makes sense because they tend to have a very specific and a very focused investment strategy, which is what makes them so efficient in that particular space. But again, as we all know, anything that's concentrated tends to have its own set of risks. Also, there's restrictions on redemptions. There's either lockouts or gates, and these are things that restrict how the investor can actually get money and when they can get money back out of the fund. So sometimes you might put your investment in and you may not be able to get it for a certain period of time, 6 months, 1 year, 2 years, something like that. Additionally, there's a lack of transparency with these investments because they're not regulated by the SEC. So there's very few to no public regulatory documents or filings. So we always recommend if a person is looking at an alternative investment, you really need to do the due diligence on the investment that you're looking into. And part of that is a result of the next item, which is that they tend to be illiquid. So as a result, it can be challenging at times to really get and determine a good value for that investment. So definitely doing your homework and doing your due diligence with these types of investments definitely pays off in the long run. And then lastly, a lot of times these types of investments are restricted to what are called accredited investors. So the individual investor, the smaller investor, doesn't always have access to these types of vehicles.
Hey, so Daniel, it looks like we have a good question here. Doesn't high interest rates hurt the real estate market?
Yeah, that's actually a good question. And intuitively, that makes a lot of sense. But one of the things to recall, though, is how interest rates affect lots of things, including mortgage rates. So as mortgage rates rise, the effect on real estate investing can actually be positive because the market for rental properties will increase because fewer people can qualify for that mortgage or they just get priced out of the market. So then they're back into the rental market. So that's what'll push up the rental prices. But that being said, rising interest rates do reduce prices. So sometimes it can be better if you're looking to buy a rental property of some sort to in a rising interest rate environment, you might be able to buy on the dip. But again, you always need to try to balance the potential decrease in the price of the property versus your increased financing costs.
Great.
So now we'll move into the four kind of generally broad categories of alternative investments. So the first is a private equity fund. And these are investments that seek to participate in the growth of private companies. So they invest in privately owned companies or public companies with the intent to take them private. And if you want to think of something that's contemporary right now, you can think of Elon Musk wanting to buy Twitter. That's an example of a private equity. That's taking a public company, taking it private, which is what I think he's going to do. He'll probably restructure it and then spin it back out to another IPO. And that's how he'll make his money back off of that. But so anyway, there are several subsets of private equity, and they include venture capital, which focuses on startups and early stage ventures, and then growth capital, which is on the other end of the spectrum. These help more mature companies to expand and restructure. And then a buyout, again, like the Twitter example, when one company or one of its divisions is spun out or purchased outright. And the idea here with these private fund managers is that they take an active role in managing that portfolio of companies. And they provide both intellectual as well as financial capital. And then they make their profit when they take the company public or they sell it to another investor. So basically they unwind the position, they take a profit, and then that gets distributed to the investors within the private equity fund. Next up, we have kind of the opposite side. So we have private equity, now we've got private debt. And so private debt or private credit is an asset class of privately negotiated loans and debt financing from non-bank lenders. So these are not the types of loans that you're going to get from Bank of America or JP Morgan or something like that. This is more an example of a high net worth individual lending $2 million to their local tire store in their town so that he can open up a second location. That would be an example of private credit. And so these tend to refer to illiquid financing provided to borrowers that can't access public credit markets, or they require non-standard or customized loan terms. And it can cover a very broad spectrum of debt, from opportunistic and distressed debt to middle market investing and specialty finance. And then within this particular category, it breaks out into two different pieces. One is corporate lending and the other is real asset lending. So corporate lending stands for private unlisted loans made to a business. So that would be the high net worth individual we just talked about. You know, he just gives $2 million to the tire owner person who just signs off on a note, and there's nothing really securing it other than his name. A real asset loan, on the other hand, refers to a loan to a business or a consumer that uses physical assets as collateral. So in this example, it could be the tire owner actually puts up his own home to secure and collateralize the loan. So that's how those two things would look like in a private setting. And the good thing here about private debt is that it's generally considered to be a low risk option in comparison to other types of alternative investments that we've discussed. And it's actually a fairly attractive option to your traditional fixed asset investments. And then next we have both real estate and commodities. So real estate includes two major sectors, both residential and commercial. Residential real estate is the largest sector, making up some 75% of the market globally. While residential real estate refers to dwellings purchased by an investor and inhabited by tenants. And this may include a single family unit or a multi-unit building, your apartment buildings or your fourplexes or something like that. Commercial real estate primarily includes office buildings, shopping centers, warehouses, those sorts of things. And generally, we look for real estate assets that are fully rented or leased, and they're under some type of a lease contract. So this helps to ensure that steady stream of income. So next are commodity investments, and these actually may involve investing in the actual physical commodity itself or the producer of the commodity. So that would be you invest in oil, so oil exploration or something like that. That would be the commodity itself. Or you take a futures contract. That would be another way you would be able to do that. Or the producer of the commodity could be you invest in shell oil, something like that. So that would be an example of commodity investing. And the thing to remember about commodity investing is the returns here are based solely on changes in price, and they do not include an income stream such as dividends, interest, or rent. And these are also real assets, mostly natural resources, such as agricultural products, oil, natural gas, precious, and industrial metals.
Hey, Daniel, we have a question here.
Mm-hmm.
Is holding real estate better than holding a commodity investment?
Well, here's the thing, as we're going to see here in a little bit, it kind of depends on the economic cycle. Commodities tend to do really well when you're in a high interest rate environment, and real estate has its own little section of where it tends to really excel. So that's a great question, and I think we're going to answer that here coming up in the next couple of slides. But yeah, we'll get to that, and thank you. Yeah. The last idea for the four general categories is hedge funds. So the one thing I want to mention here is these first three types of funds, they are more about risk mitigation, inflation hedging, and that type of stuff. Hedge funds are the other side of that. Hedge funds are more about high equity value returns. So that's what a hedge fund is really looking for. So with that being said, so these are investments that have broad flexibility in the types of strategies they can employ to follow the stated investment objective. Now, they all have different objectives. So for example, you have what are called equity hedges. They try to end up being something what we call market neutral. An event-driven hedge, which is generally they're looking for arbitrage opportunities. So when two assets are mispriced, they'll try to get in on that, and then they take an advantage of the mispricing. Relative value, this is looking at convertible bonds and arbitrage within the bond market. And then commodity trading advisory funds, which is the commodity trading we talked about earlier, but on a more risky side. There's a lot more futures going on in that type of a fund. So these hedge funds are investment funds that tend to trade relatively liquid assets. And again, as we said, they employ various strategies with a goal of earning a higher return on their investment. So again, this is an idea when you've got high economic activity going really, really well, where you have an opportunity, you feel, to make some outsized returns. And in that part of the economic cycle, the hedge funds start to look good. And for some of you, if you remember back in the mid to late 80s, when the economy was doing quite well, we heard a lot about hedge funds back in that particular time. The good thing is we're seeing more and more what's called a fund of hedge funds that are being created. And it helps to create that diversified portfolio within the hedge fund space. And it also helps make them available to the smaller investor. So this is a type of hedge fund where it invests maybe in 5, 6, or 10 different hedge funds. It puts them all together and wraps them in a little basket for a person to buy into. So it's a way to actually diversify the risk a little bit within what tends to be a very risky environment.
Hey, so Daniel, we have another question, and I think you touched on this a little bit here, but why is private debt considered low risk?
Oh, okay, yeah, good question. So in the case of a real asset type loan, the debt secured by the asset. So for example, the tire store we were talking about, or the office building. So in an event of a default, the debt holder gets to take possession of that property, and they can either sell it, or if they want to keep it for, they want the income stream, or they think they can sell it for more, later down the road. But in the case of corporate or small business lending, that debt is in a senior position to any equity holder. So they're going to get paid first. And then the debt may be assumed by the borrower. So their assets may be used to satisfy the debt. And the other thing too is within this space, these lenders get to know their borrowers really, really well. So a lot of times there's more willingness to work out the loan so that the lender doesn't actually go into default. So it's a way to continue to carry the debt forward and keep the debt service over the long term. So here's the chart I was referring to earlier. So the question was real estate versus commodities. So if you look at the graph, what basically going from left to right is economic growth. So low growth on the left, high growth on the right, and going the up and down axis is inflation. So low inflation on the bottom, high inflation on the top. So if you look at where commodities land in an economic environment that has low economic growth, but high inflation. And we talked about that because the rents are going to be rising and you have contracts. However, when you look at real estate, it tends to be the other way. It looks for low economic growth, but low inflation. Sorry, I got those mixed up. So the commodities are rising in prices because they're positively correlated to inflation. That's why you want commodities in a high inflation environment. I apologize for that. But in a low inflation environment with low economic growth, that's the real estate portion, because you have a locked in consistent income stream so that you're not getting so you get some return in an environment that's not really giving you much in terms of equity growth or debt growth, because interest rates are going to be low because interest rates are low. Equities aren't going to be returning very much because economic growth is low. So you're looking for those things that can give you some amount of consistent return. So that's income generating assets, which is that real estate assets that are fully rented out, fully leased out. So hopefully I was able to answer your question. Sorry, it took me a little bit to get to it. But what the chart does show, which we've already talked about, is how the economic cycle drives the asset selection. And so the graph kind of does show where you are in the cycle, where you might want to be, investment vehicle wise, because each asset has its own unique character and it's going to perform differently depending on where we are as economic conditions change. So again, for example, which we already talked about, in periods of low inflation, especially with low growth, commodities will do poorly in those types of periods, where they do well in periods of high inflation and high economic growth. And so when we look back at the last 10 years, you can see we've been in a period of low inflation with moderate to high growth. And that directly benefits that more traditional 60-40 portfolio, 30-70 portfolio, whatever. But the 60-40 portfolio over that time has returned an average annual compound rate of 9.8% in that time frame. However, as we now know, we're entering a period of high inflation with the potential for slow growth as the Fed continues to ratchet up interest rates. So we need to see a need to begin a shift away from this traditional 60-40 portfolio or 50-50 portfolio or 40-60, whatever it might be, and into a portfolio that includes some degree of alternative investments. So this table here on this slide actually shows you a comparison of performance returns from a baseline portfolio, which is 35% fixed income, 5% cash, 60% equity, so no alternative, to a portfolio that has 30% fixed income, 5% cash, 45% equity, and 20% alternatives. So when you look back over the last 12 months, which includes a greater than 20% decline in both the NASDAQ and S&P 500, we see, due to that low correlation, remember we talked about that earlier, that low correlation, the portfolio with the alternative assets has a significantly lower loss when compared to the 60-40. The 60-40 was down almost 12% over the last 12 months, while the alternatives portfolio was down only 4%. Conversely, when you look back at the last 24 months, which includes significant gains in the broad market index during the back half of 2020, remember that was the pandemic bounce we had at the back half of the year, the alternative investment portfolio outperformed the 60-40 portfolio by more than 5.5 percentage points. So the baseline was up a little more than 4%, while the alternative was up 10%. But I do want to make one thing clear. It should be noted that this strategy does require close monitoring, so that as economics conditions change, the mix and type of alternative investments can be updated. So as we saw on the last slide, some assets are better suited to certain conditions than others. So this is definitely, not a fire and forget strategy.
Hey, so Daniel, we have a great question here. How do you invest in alternative investments?
Okay, great. So basically what we're going to do though is, so as we mentioned earlier, these types of investments are generally limited to accredited investors. However, there are some ETFs and mutual funds that might fit into one of these strategies. So for most people, really this is going to be accomplished by speaking with their own wealth advisor, the person who manages your assets. And they should be able to help you find the appropriate vehicle and help incorporate them into your portfolio. But if you don't have an advisor, or this is not something your advisor does, feel free to reach out to us here at Sierra Pacific Financial Advisors, and we'll be more than happy to sit with you, meet with you, find out about your situation, and then see how we can best help you execute on this strategy. Which kind of leads us into our slide here, like who we are at Sierra Pacific. So we are a holistic wealth management firm. So we don't just do investment management. We also do retirement planning for those close to retirement or in retirement. How can we optimize retirement fund withdrawals? We also help folks with tax planning, whatever that might look like, from Roth conversions to executing RSUs or ISOs, which we also have experience helping our clients here in the Bay Area and in Silicon Valley in particular with those types of equity compensation. College funding, we know college isn't getting any cheaper. We like to help our clients figure out how to fund that. Also, risk management and insurance analysis. So how do we make sure that your family's protected if something unfortunate were to happen? And we have a lot of clients who have a charitable gifting desire. So we have really good ways about how to achieve charitable gifting in a tax efficient manner, and also help with estate planning. Because as we all know, the Tax Cut Jobs Act of 2018 is going to sunset in a couple of years. And so folks who don't have an estate tax problem right now very well could have that challenge coming up in the next few years. And then lastly, we do have a professional team for corporate retirement solutions. They're experts in helping small and medium-sized businesses, create, manage, and their corporate retirement plans, from 401k plans to profit sharing plans and pension plans. So everybody, that's it for the main part of the presentation. For any additional questions and answers, we're happy to take those from the audience right now.
So Daniel, we actually do have a few good questions here. The first one is, what is an accredited investor?
Oh, okay. Yeah. An accredited investor. So first of all, it's a real person, and it's anyone who has income that exceeds $200,000 per year or $300,000 per year if you're married in each of the last 2 years. And you have a pretty good chance of making that same amount of money going forward. It can also be a person who has a net worth of $1 million, either alone or with their spouse, excluding their home. So this is your investable assets. Also, accredited investors can be those people who have certain stock and trading certification, Series 6, Series 7, those types of things.
All right, and so we have another question here. Is there a minimum requirement to invest in alternative investments?
Okay, so it ties into the previous question in that generally, yes, there are restricted to accredited investors. But as we said, there's a growing inventory of ETFs and mutual funds out there that specialize in some of these different items that we've talked about: commodity trading, real estate investing, those types of things, private equities as well. So these funds generally do have some amount of a minimum investment, and you would just need to do the research on the fund you're looking at. And that minimum investment, it'll vary from fund to fund, but you'll be able to find that in the fund's prospectus.
Okay, and one more question here. Is it easy to redeem the alternative investments? Are there any fees, redemption fees?
Oh, yeah, great question. So typically these funds are illiquid. So meaning you can't just buy and sell them like you can a stock or a bond. And they generally have what we call lockups or gates. So a lockup is a period of time when the investor cannot sell a particular investment or security. And a gate is a provision that refers to the fund manager's right to limit or halt redemptions in certain circumstances. So again, it's not like you're buying a mutual fund or an ETF where you can just call up, sell it, and you get your money back. Oftentimes there's going to be some restrictions on being able to get back your money or a penalty. And also, speaking of penalties, there could be a redemption fee, which is like a penalty. So you might have to pay a redemption fee again if you get out earlier than what the initial, investment period was defined as. Yeah.
Hey, and we actually have one last question coming in. So what makes SPFA better than or different than other competitors?
All right. Well, you know what? I don't know if we're better per se, because there's a lot of really good financial advisors out there. But what I will say is that among our differentiating factors is that we are fiduciaries for all of our clients, and we always put our clients first and security first above all else. So we're always trying to work on our clients' best interests. We're a registered investment advisor, an RIA, and we have 2 CFPs on the team as well. So again, always required to work in our clients' best interest. And then also, I'd say we have experience working with high net worth clients here in the Bay Area and Silicon Valley, and we kind of understand their unique financial situation living in this area creates. And I'd say we're able to help them plan and navigate through those challenges.
Great. Thank you so much for explaining how we separate ourselves here. So we want to thank everyone for attending today's webinar. We appreciate your time. If you would like more information on this topic or would like to set up a meeting with us here at Sierra Pacific, please feel free to reach out to us. You may reach us by phone, email, go to the website, schedule a 15-minute consultation. Again, thank you so much for your time, and I hope everyone has a good afternoon.
Thank you, everybody, for coming. We appreciate your time. Have a great day.